Welcome back to the channel. If you are new here, this is the place where we talk about real money and real strategies that everyday people can use to build wealth, get out of financial stress, and actually retire with enough money to enjoy life. Today we are talking about one of the most important questions you will ever ask yourself when it comes to your financial future. How much should you actually save for retirement? And more importantly, how do you know if what you are saving right now is enough? Because most people are just guessing. They pick a number, hope it works out, and find out too late that their plan had holes in it. Today we are going to change that. By the end of this video, you are going to know exactly how to think about your retirement savings, what numbers to use, and how to build a plan that actually holds up. If you have not subscribed yet, hit that button now. Let us get into it. If someone told you that one single number could be the difference between retiring comfortably at 65 and working until you are 75, would you want to know what that number is? Of course you would. Now here is the scary part. Most people never think about this number. They just save whatever they can, hope for the best, and find out too late that their plan had a hole in it the whole time. That number is your annual rate of return. And in this video, we are going to break it down completely. What it means, how to pick the right one, and how to use it so your retirement plan actually holds up. Stay with me because by the end of this video, you will understand something that most people spend their entire working lives getting wrong. Let us start with the basics. When you invest money for retirement, that money grows over time. Every year, your investments earn a return. That return gets added to your balance. Then next year, you earn a return on the bigger balance. This is called compounding. And over 30 or 40 years, it turns small monthly contributions into life-changing amounts. But here is the thing. The size of that life-changing amount depends almost entirely on one thing: the rate at which your money grows each year. That is your annual rate of return. Now you might think, okay, what is the big deal? If I save enough, the rate does not matter that much, right? Wrong. Dead wrong. Let me show you with real numbers. Say you invest $500 per month for 35 years. At a 6% annual return, you end up with about $595,000. At a 7% annual return, you end up with about $756,000. At an 8% annual return, you end up with about $966,000. That is the same $500 per month. The same 35 years. The only thing that changed is 1 or 2% in the rate of return. The difference between 6% and 8% is nearly $370,000. That is not a small gap. That is the difference between a comfortable retirement and a tight one. That is the difference between traveling in your 70s and worrying about your heating bill. So yes, this number matters, and the mistake most people make is that they either pick a number randomly or they use whatever sounds good without understanding what it actually means. That is what we are going to fix today. Here is something most people do not know. When you hear that the stock market returns 10% per year, that number can actually be misleading. Not because it is fake, but because of the type of average being used. There are two kinds of averages when it comes to investment returns: the simple average and the compound annual growth rate, which people call CAGR. Let me explain the difference with a simple example. Say your investment earns 50% in year 1. Then it loses 50% in year 2. The simple average of those two numbers is 0%. So, according to the simple average, you broke even. But let us follow the actual dollars. You start with $1,000. It goes up 50%. Now you have $1,500. Then it drops 50%. Now you have $750. You did not break even. You lost $250. You lost 25% of your money. But the simple average told you that you made nothing. This is why the simple average is useless for planning. It does not tell you what actually happened to your money. CAGR does. CAGR tells you the steady annual rate that would have taken your starting balance to your ending balance over the same time period. It accounts for the ups and downs. It gives you the real number. So when you are planning your retirement, always use CAGR. If someone gives you a simple average, ask them for the CAGR. It is the only number that actually means something for your future. Now, let us talk about what kind of returns you can realistically expect. Since we cannot predict the future, the next best thing is to look at the past. Markets do not repeat exactly, but over long periods of time, they tend to follow patterns. Those patterns give us a useful starting point. The most talked about benchmark is the S&P 500. This is an index that tracks 500 of the largest companies in the United States. Companies like Apple, Microsoft, Amazon, and Google. When people say the stock market is up or down, they are usually talking about the S&P 500. Over the last 100 years, the S&P 500 has returned about 10% per year on average before adjusting for inflation. That sounds excellent, and over the long term it is. But here is what that 10% looks like in real life. In 2008, the S&P 500 dropped 38%. People who had most of their savings in stocks saw nearly half their retirement money disappear in 1 year. In 2020, during the early days of the pandemic, the market dropped 34% in just 33 days. That is one of the fastest crashes in history. And in 2022, the market dropped around 19% in a single year. Now, in every single case, the market eventually recovered and went on to hit new highs. But here is the problem. If you are 62 years old and the market drops 38%, you do not have 10 years to wait for a recovery. You need that money soon. This is why most financial planners do not recommend putting 100% of your retirement savings into stocks, especially as you get closer to retirement age. So what do they recommend instead? The most well-known balanced strategy is called the 60-40 portfolio. It is exactly what it sounds like. You put 60% of your money into stocks and 40% into bonds. Stocks give you growth. When the economy does well, stocks go up. That 60% is what builds your wealth over time. Bonds give you stability. When stocks drop, bonds usually hold their value or even go up. That 40% is what protects you when things get rough. Together, they balance each other out. You give up some upside compared to being fully in stocks. But you also protect yourself from the worst crashes. Over the last 30 years, a 60-40 portfolio has averaged about 8.28% per year before inflation. After adjusting for inflation, that comes down to around 5.42%. That is still a strong return, and it comes with far less stress than riding the full ups and downs of the stock market alone. Now, is the 60-40 portfolio perfect? No. In years where both stocks and bonds drop at the same time, like 2022, it gets hit hard. But over long periods, it has been one of the most reliable strategies for everyday investors. The portfolio you choose determines the rate of return you should plan with. And the rate of return you plan with determines everything else about your retirement. So now the big question: what rate should you use? The honest answer is it depends on you. Specifically, it depends on your risk tolerance. Risk tolerance is just a fancy way of asking how much you can handle watching your money go down before you panic. Because here is the truth. At some point, your investments will drop. It is not a matter of if. It is a matter of when. The question is what you do when that happens. If you stay calm and keep investing, you will be fine. Markets have always recovered over time. But if you panic and sell when things drop, you lock in your losses. You turn a temporary dip into a permanent one, and that destroys your retirement plan. So be honest with yourself. If you are aggressive, meaning you are comfortable with 90 to 100% of your money in stocks, and you can stomach big swings without panic selling, then you can plan with a 10% estimated return. If you are somewhere in the middle, a 60-40 mix or something close to it, then plan with 6% to 8%. If you are conservative, meaning you keep a lot in bonds or even cash because you cannot handle seeing your balance drop, then plan with 4% to 5%. Now here is a suggestion that might surprise you. Even if you think you are aggressive, consider using 6.5% as your planning rate. Why? Because planning conservatively gives you a built-in safety margin. If your investments return 9% or 10%, great. You end up with more money than you planned for. That is a good problem to have. But if you plan on 10% and only get 7%, you could end up short. And finding that out at 65, when it is too late to fix, is not a position you want to be in. 6.5% is not pessimistic. It is smart. It is the kind of thinking that separates people who thrive in retirement from people who struggle. We have talked about returns, but there is something else that most people completely ignore when they plan for retirement, and it quietly destroys more retirement plans than almost anything else. It is called inflation. Inflation is the rising cost of everything over time. Groceries, gas, healthcare, housing. Every year, things cost a little more than they did the year before. The average inflation rate in the U.S. has been around 2% to 3% per year over the long term. That does not sound like much. But let me show you what it actually does over time. If inflation runs at 3% per year, the cost of living doubles roughly every 24 years. That means if you need $50,000 per year to live comfortably today, in 24 years, you will need about $100,000 per year just to maintain the same lifestyle. Not a better lifestyle. The same one. Now, here is where it connects to your rate of return. Your real return is not the number your investments earn. Your real return is what is left after inflation takes its cut. If your portfolio earns 6% and inflation runs at 3%, your real return is about 3%. That is what is actually growing your purchasing power. This is why you can never just look at your investment return in isolation. You always have to think about what inflation is doing at the same time. When it comes to planning your withdrawals in retirement, this becomes even more important. Say you retire at 65 and plan to withdraw $60,000 per year. At 3% inflation, by the time you are 80, you will need about $93,000 per year just to afford the same things. If your withdrawal rate does not account for that, you will slowly run out of money even if your investments are performing fine. So what do you do about it? Two things. First, adjust your savings goal upward. Do not just plan for what you need today. Think about what you will need 20 or 30 years from now when everything costs more. Second, use your inflation-adjusted return when you do your projections. If you expect a 6.5% return and inflation averages 2.5%, plan with a real return of about 4%. That keeps your numbers honest. Ignoring inflation is like planning a road trip and forgetting to account for gas prices. You might start fine, but somewhere along the way, you run short and get stuck. All right. Let us bring everything together. You now know why the rate of return matters so much. You know the difference between a simple average and CAGR. You know what history tells us about stock market returns. You know how to pick a rate based on your risk tolerance. And you know how inflation chips away at everything. So here is how you actually put this all to use. First, decide on your investment strategy. Are you aggressive, balanced, or conservative? That tells you your expected return range. Then pick a rate on the lower end of that range. If you are balanced and expect 6% to 8%, use 6% or 6.5% for planning. Give yourself that safety margin. Next, Subtract your expected inflation rate from that number. If you expect 2.5% inflation, your real planning rate is around 4%. Use that real rate to figure out how much you need to save each month to hit your retirement goal. Finally, review this every few years. Your situation changes. Your risk tolerance changes as you get older. Your portfolio should shift too. As you get closer to retirement, it usually makes sense to move more money from stocks into bonds to protect what you have built. This is not a one-time calculation. It is a living plan, and the people who treat it that way are the ones who actually retire on their own terms. Here is the bottom line. Retirement planning is not about being perfect. It is about being honest. Honest about what you can expect from your investments. Honest about what inflation will do to your money, and honest about your own ability to handle risk. The people who get this right are not financial geniuses. They are just people who took the time to understand the basics and used real numbers instead of wishful thinking. You now have those basics. Use them. Pick a realistic rate of return. Plan conservatively. Account for inflation. And start as early as you can because time is the one thing you cannot get back. If this video helped you, hit that subscribe button. We put out content on building real wealth, understanding money, and making smart financial decisions at every stage of life. See you in the next video.